Hi, everyone. Welcome to day 3 of the Psychology, Discipline, and Time Management 2023 conference. This is Synergy Traders event number 45, and this is brought to you by TradeOutLoud.com, Anka Metcalf, and myself, David Kosmeter of TimingResearch.com, along with our co-sponsors, one of which is Price Headley, who is going to be our opening presenter for today. So just a reminder, of course, that all of these presentations are for educational purposes only. Trading is not suitable for all people, so please consult a financial advisor and only trade with money you can afford to lose. So all of these sessions also are being recorded individually and will be available on TimingResearch.com as soon as I can get them processed. So start off the day today. I'm going to go ahead and turn it over to Price Headley of BigTrends.com.
Thank you so much, David, and good morning, everybody. Thrilled to be able to lead off the final day 3 of another full packed session day worth of many sessions of great speakers and fellow traders. And, I wanted to start off by saying, that, obviously with the topic, psychology, discipline, the whole idea of effective trade management, it kind of goes back to having a diversified approach, right? So my topic, 14 different strategies for serious options traders, kind of is geared to encompass not just option strategies, but a lot of the elements that go into successful trading, whether you're an options trader or any other type of trader. The principles are the same. And so we're going to walk through just a few of those 14 today, but then give you the ability to access all of those and get lifetime access to be able to sort of soak them in at your leisure over time. And, I've been trading for 33 plus years. So it's one of those things where, you realize that, it's the long game you want to play. Even if you're using short-term strategies, you want to make sure you keep yourself in the game for the long haul. As we start off here today, just kind of like David alluded to, the idea that everything that I'm sharing with you in today's presentation is based on our proprietary research and is intended for illustrative purposes only. What we talk about today should not be considered specific advisory recommendations in any way. As you know, stock and options trading have large potential rewards, but also large potential risk. So, only, as David said, only trade with capital you can afford to lose. And knowing how to lose properly is part of successful trading. So we'll talk about that too. The past performance of any trading system or methodology is not necessarily indicative of future results, and do see our terms of use on our BigTrends.com homepage for more information in this regard. So if you don't know me, I've been trading for 33 plus years. I caught the trading bug while I was down as a student at Duke University, and upon graduating from there, became a analyst and then head of research for the nation's largest options newsletter in the 90s, and then started BigTrends.com in 99. So we're now in our 23rd plus year, had actually our 24th, I guess, our 23rd anniversary last November. But, the idea is that it's got to be based on data. So when we talk about anything that I share with you, it's been tested oftentimes across decades worth of data, many thousands of potential signal points, so that we're getting the ability to say, do we have an edge if we trade this system over all kinds of different markets, right? So it's knowing how to trade bull markets, bear markets, and sideways choppy markets. So we'll cover all of those in today's presentation, and been blessed to serve many tens of thousands of folks all around the world with our insights as to where you can get an edge in trend trading, whether you trade stocks, options, or some other vehicle. A few highlights from my 33 years of trading. One of my big highlights was in the first year after I launched BigTrends in November 99, about 10 months later, was featured in Barron's September 11th, 2000, a year before 9/11, actually. And I said, watch out below, because the sentiment, which has always been something that I track in addition to the charts, is the sentiment is something where there was way too much optimism back then to buy techs on the dip, right? That's what you don't want to see, is the crowd saying, oh, this is a great buying opportunity, because if the stocks are going down, somebody's selling it. The big institutions are selling it. And if the average Joe investor is saying, what a great gift of a buying opportunity, it's probably not, right? So we said, watch out below. That proved to be a good call. It had the decline into 9/11. Then the markets bounced back after 9/11. Over the next 6 months. And then I said, there's still too much optimism. People still think that this is a golden buying opportunity, and said, watch out. There was another leg down over that next 9 or 10 months till the market finally bottomed in March of 2003. But, because of the things I've been able to not just teach, but share with people that I've learned, kind of standing on the shoulders of giants in the trading industry, was blessed to be inducted into Traders Library's Traders Hall of Fame back in 2007. And kind of, I hope that, you can learn from what I've learned, that you can stand on my shoulders as well in what I want to share with you today. But in addition to what I'm going to give you access to as a lifetime kind of ongoing training series of boot camps, we'll get into that later. But let's talk about why we're opening the doors to you to this entire archive of our training on our big trend strategies. We call it our full boot camp series. We call it our regiment of all the boot camps that I've done in recent times. These are all very fresh as well. So we're going to go into that, but first, the key is, do you know what kind of trader you are, what you're looking to accomplish in your trading? It's important to have a clear goal of that, and then to know what option strategy or other trading strategy syncs up the best with your trading goals. So when I talk about a dozen plus different strategies, I still say you got to walk before you run. You've got to really master one strategy at a time. And that's why I give lifetime access as part of today's special when we get into it. But the idea, so you can sort of not feel like you're in a hurry to try to get it before it expires. You want to sort of soak it in over time. Now, if you're an aggressive options trader, a lot of aggressive traders like to buy cheaper out of the money options. And the reason it's aggressive when you buy these out of the money options is there is no intrinsic value when you first buy it. Now, it can gain intrinsic value as it goes from out of the money to in the money. If you're new to options, the idea of out of the money means if a stock's at 100, if you buy the 105 call, that's 5 points out of the money, right? You've got a right to buy it at 105. It's not going to be worth anything until it rallies at least 5 points. Or more before the expiration. Although as it rallies quickly, even if it stays out of the money, you can make money with those because it's moving closer and closer to the strike price. But you don't want to hang around very long in those strategies because the time is working against you more aggressively. That's where most traders that start with aggressive out of the money buying have gotten themselves in trouble and end up kind of swearing off options because they make a mistake of buying and holding something like that for too long. They do have the potential to double, triple, or more in value. We've had a lot of success with our aggressive options programs. Of course, but we've had our share of knocks as well, right? Because you're going to have a lower win rate with that type of strategy, a greater risk that they could expire worthless or take a bigger hit. And so that risk is something that I tend to not start new options traders on that end of the spectrum, because I want to keep you in the game for the long haul. I've been blessed to be in the options game for more than 3 decades because I said, look, let's take a more conservative approach. Even when I was building my capital up to start Big Trends, I was mainly trading this more conservative approach of in the money options. Sure, sometimes still on tech stocks and internet stocks and things back in the mid to late 90s, how I built my portfolio up to launch BigTrends.com in 99. But the in the money options, they're more expensive, meaning you'll be able to buy fewer contracts, control fewer hundreds of shares. Remember, every option contract controls 100 shares, but at least you're buying intrinsic value, right? If the stock's at 100 and you buy the 95 strike call, that's got $5 of intrinsic value. The 95 call means a right to buy at 95. You could theoretically exercise that and go in the market and then sell it back out from 95 to 100 and make that 5 points. You wouldn't typically want to do that because there's a time component there as well in those 95 calls. But the idea is that it will reduce your leverage. It will reduce your time risk. It will give you more stability. You won't have as many huge winners percentage-wise. You might change your targets to the 50 to no more than 100% range rather than the triples and quadruples, but you will limit your time risk. So that will lower, if it doesn't move at all, it will lower the hit that you take when you buy an option and nothing happens. Okay. So it will reduce your risk compared to out of the money option. But every trade has risk, right? Even if it has a big gap against you, even in an in the money situation, you can still lose what you put into that trade, right? I always want to make sure traders know coming in the downside as well as the upside. So you hear me talk a lot about that. We're not just preaching our greatest trades ever. We're talking about reality trading here. And that reality is you're going to have to deal with how you manage losses and where you get out. So we'll talk a little bit more about that. So when you think about time frames, again, it depends on your trading style. So the day trader is saying, I'm not going to hold it past today's close. I'm in some point today, I'm out by the close, because they don't want the overnight risk. And a number of day traders that use leverage even on the underlying stocks are going to not want to carry that leverage in overnight and worry about a gap situation against them. Most of what our strategies tend to evolve into is more of a swing trade. So that's where I would put a lot of our emphasis, 2 to 5 day holding periods. So that way, instead of using a really short term, say 15-minute chart, we might use, say, a 30 or 60-minute chart if it's a quick swing trade of 2, maybe 3 days, it could be a 30-minute chart. Or if you're looking out about a week, it would be an hourly 60-minute chart, meaning that every hour those price points and you're getting new bars, new points of reference after each hour prints and closes. So that's been valuable. Also, position trading still has a place. So that's another benefit. Typically for us, it's anywhere from a week to a few weeks out, but you see in some cases, the traditional definition could be anywhere from 1 to 6 weeks out, up to a month usually. And that's where we're using a daily chart. So I still keep an eye on the daily chart no matter what. And then for intermediate term traders, 3 to 12 month holding period using weekly charts. And then if you're a super long-term investor, you could even use monthly charts for a year plus holding period. So there's something for everybody. And what we remind people is that the indicators and strategies that we teach for swing trading can still be applied to longer time frames. So we'll share with you some of those today. Now, when you think of the most common misconceptions, probably the number one most common question we get at BigTrends about how good our services are that somebody's trying to evaluate is they will say, what's your winning percentage? And a lot of people, you get the emails that say people promising 90%, 95%, or whatever win percentage. And that's not really the only metric that matters. The reality is that you can have a great winning percentage, but then when you are wrong, you basically blow up your portfolio, right? There's been even some of the best and brightest on Wall Street that have experienced the minority of their trades taking them down because they didn't have risk management on when it really went against them, right? So what else matters besides winning percentages? How big do you win? The size of your average winner compared to the size of your average loser. And so if we win an average of, say, just for something simple, say $300 on an average winning trade, and then we lose on average $100, well, then that 3-to-1 win to loss ratio, which would be this next kind of calculation here, would be very valuable, right? If you can win 3 times as big as you lose, even with a 50-50 win rate or even less than that, you can still have a pretty good growth in your trading account. So you don't have to be just hitting super high win rates. Also, of course, what's your maximum drawdown? That's your peak to trough drop in your portfolio along the way. And we like to remind people that, even if you look back and say, oh, my system never draws down more than 20% peak to trough, we always like to say, think that your maximum drawdown could be in front of you, not behind you, right? In the future, you could experience, we like to say, project double what your history says. If you project a 20% loss, well, then project that. What if it was a 40% loss? Could you handle it? Could you stay in the game? Would you not be so leveraged that you would get thumped if it goes beyond your typical expectation of drawdown risk? So always kind of planning for sort of worse than expected history, worse than expected future outcome compared to the past is a good idea. It will keep you less leveraged. It'll keep you more sane when you do go through the occasional drawdown along the way. Not many people are talking about that because nobody wants to think about what they could lose in their trading account. But if you think about that on the front end, then you position yourself to know that you're going to, maybe you say, well, I'm not maxing out my account in maximum leverage. That's a good thing. That's if you max out your leverage, it will eventually catch up to you and blow you up. So you want to say, look, I just want to stay in the game for the long haul and keep building wealth and doing it in a reasonable way, not having to do it in the most maxed out leveraged way. So when you think of psychology of trading and the discipline that goes into whatever your trading strategy is that the capital allocation oftentimes dramatically affects how you're going to feel about your trades, win, lose, or draw. The more you allocate per trade, the more you're basically going to increase your volatility, and thus not just your financial volatility gets increased, but also your psychological and emotional volatility with what you experience in your gut. Your gut reaction is going to be just that much more churned by too much allocation per trade. And 10% per trade would actually be probably the most that we would recommend. For example, like it depends all about your portfolio size, right? If what we would say is that, for a typical starter options account, say, $10,000, if you're putting 10% per trade of that $10,000, that would be $1,000 in a trade. If you're putting 5,000 to start, that would be $500 a trade on a 10% allocation per trade. When we talk about $5,000 a trade as a set dollar amount, well, then, you better be trading a $50,000 portfolio or more, in my view, if you're going to keep it at that 10% or less per trade allocation. And I would even probably recommend when you're just starting out, maybe starting smaller than that per trade, maybe cut it in half to say 5% a trade. So no one trade makes or breaks you. You're looking at taking an edge and extracting it over a longer series of trades. Now, with commission rates having come down so much with no minimum ticket charge on options, even if you're just trading one contract at a time, just to learn, that's also acceptable, right? So the problem with the set number of contracts per trade is that you could have one option at, say, $1 or $100 a contract. You buy 10 contracts of $1 option, that's $1,000 invested. But then the next trade you make is, say, $5 or $500 a contract. If you're doing the set 10 contracts a trade, now all of a sudden that next trade, 10 contracts times 500, you're at $5,000 invested. It doesn't promote an even dollar allocation per trade with a set number of contracts every time. So unless you're just doing the one contract at a time, which could work, just to say, I'm just going to prove that I can follow this system over a number of trades, then I wouldn't tend to recommend going with this fixed number of contracts. I'd rather see a fixed dollar, fixed percentage. Either way being probably a more balanced approach. Now, let's dive into one specific trading style and option strategy that's really grown a lot in popularity, and it's weekly options. The beauty of weekly options is that every Friday becomes an expiration Friday. You may have even heard of the 0 DTE, the 0 days to expiration options. We're not really trading those per se here, but we're saying, look, if you're looking at about a week out to 2 weeks out, to even 4 weeks out here, you're saying I can choose, the right week of expiration that I want to make this trade. This allows you to sort of position and be in and out before, say, an earnings report comes out. We know Apple's coming out after the close today. I'm not recommending you trade this right in front of earnings because you're going to experience a lot of volatility with that type of an approach. But you can say, well, if you knew that those earnings were coming out, say, 2 Fridays from now, we could get in and out before next Friday's expiration. So you can basically position yourself to not have to pay for that earnings volatility and kind of trade around it is my preferred approach. The beauty of this is you can be targeted about how you hop in and out, and even with the Fed news yesterday, which again, I always remind people on Fed reactions that, the first reaction right after the Fed announces we're raising another quarter point, the market started to rally hoping about that Fed pause. And that first reaction is often a fake out on the Fed news. So be careful about trying to trade right around that news hitting the wires, because you'll see a lot of fake outs there. We're looking for getting rid of those fake outs and trading more of the true trend. So I'm going to share with you my favorite way that we like to trade weekly options. And we have a number of different weekly option strategies here at BigTrends, and we cover those in my weekly options boot camp. This is just one of the 14 kind of access point boot camps that you're going to get access to at the end of my presentation with a special flash sale we've just set up for today's event. But the idea is that each of these sessions are something that I've recorded and shared my insights about what works for me on a given option strategy. In this case, using weekly options with an indicator called the ADX indicator, the average directional movement. I'll show you a chart of that here in a couple minutes. But the idea is that ADX is a really nice indicator, the way we use it to show you if the trend is just getting started. I think one of the biggest questions when as a trader you see a breakout and you go, am I too late? How many times have you thought you were too late and you look back and say, man, I could have made money on that trade? So what we'll do is we'll use them on a number of different stocks, including the FANG stocks, right? The Facebook, now called Meta, Apple, Amazon, Netflix, and Google now called Alphabet. But the idea is that we trade these options on these 5 big FANG names, and that's worked out really well. And then we added, because of the success of our FANG ADX system, we added another additional set of names, including Microsoft, and what we call our weekly options warrior trades. So we've got a lot of non-tech names in that WOW portfolio, weekly options warrior, and we actually go deeper into the strategy and into the little nuances of how to manage the trades. So the beauty of these boot camps is that they're archived. You do, though, get also a dedicated email address to me and my analysts whenever you've got a question on any boot camp material. And it basically walks you through, how do you manage trades that are working? How do you manage trades that aren't working? When do you get out? When do you get in? What type of strike price do you buy? What kind of, how much time do you give yourself? All those questions get answered in the boot camps. So you should have complete clarity about what you should do to implement those trades. And of course, we have a FANG options trading portfolio, so you can also then later add in the alert services once you learn which strategy you think best fits your trading objectives. So the idea of this is that that's 3 hours worth of content. Each of these sessions is typically about an hour, give or take. And so the idea is that you get like 3 hours of training, and that's just alone. You think about what one trade can make you or cost you, right? If you do a trade right, you know, you're investing $1,000 with our strategy here. We're looking to usually double that. So one good trade can make us $1,000. If you do it wrong, of course, you put $1,000 in, you do it totally wrong, and you let it blow up on you, it could cost you $1,000, right? So it's really important to get aligned with what's working, and also to reduce those bad trades that we've all made. I've made them. You know, the idea is that, you know, usually when I got myself in trouble, it was because I wasn't following an indicator or a system. I was going off of my gut, or off of some fundamental metric that said, hey, this stock's a value and therefore you should buy it. And guess what? If it's in a downtrend, you should not buy it. Okay. You should wait until the trend indicators come and say, now it's trending up. Now you can buy it. That's the power of technical analysis. Even if you're using a fundamental analysis filter like price earnings ratios or earnings surprises or whatever, that, you know, you want to make sure that you're getting that validation in the technical analysis. So with the FANG names, you say, what's your performance been using this weekly option strategy? This is our FANG options trader portfolio, assuming even if you started with a $5,000 account, looking at all the ups and downs of the market, with the bear market last year, the prior bull market of 2021, of course, the pandemic drop in 2020, you go all the way back to 2016, and you see that this portfolio has basically, you can see, gone up 203%, adding up all gains and losses before commissions or subscription investments. So the idea is that, okay, you could take a $5,000 account to some $15,000, and basically, of course, that'd be making you roughly about 10K on your 5K, turn it from 5 to 15,000. So the idea of this is that no one trade's going to be too much risk, but the idea is that you can focus yourself on, while every trade has risk, it's going to say, make it a risk that you can manage, make it a risk that you can accept when it's time to get out, that you can accept taking the 20 or 30% loss, or possibly more if it gaps against you, while also positioning for the potential 100% gainers. So it's about this bigger size of win versus smaller size of loss that really helps guide us in that portfolio. Let's look at a trade example. A chart's worth so many more words. This is a Alphabet being the parent company of Google now, but GOOGL is the symbol that we trade options on. Google and Amazon last year, they had been up earlier in the year last year in the multi thousands, right? And they both split like 20 for 1. So brought these stocks down to, you can see Google when it was signaling here, just over $94 here. Okay, $94 a share. It used to be in the several thousand range, right? But what are we looking at on this bottom panel here? Okay, the bottom panel shows us that the ADX, which is the green line, that's the average directional movement. That is basically a trend indicator. When ADX is rising, that tells you that that security is trending. In this case, the directional movement lines I overlay on this, and these are developed not by me, but by Wells Wilder, one of the true trading legends out there, coming up with a lot of different systems and indicators that added value. Show you that the net new highs, which is the blue line, the positive line, net new highs have been rising, right? The red line's the net new lows, which when you look back, you see even when you look back when it wasn't making that many new lows, but not really making any new highs either, you can see that that lower boundary is also making higher lows. So we're not making that many new lows either. So that's why the red line's dropping, the blue line's rising. As those two diverge from each other, those positive and negative directional movement lines, the ADX picks up that, hey, there must be a trend developing because we're getting this channel of higher highs and higher lows. You know, that's called an uptrend. The key here is that you never would trade ADX when it's rolling down, and we wait for ADX to come up off of a relatively low level and then cross this diminished red negative directional movements going down. So when we see that ADX start to cross up, it's at that potential bar that, and these are, by the way, 30-minute charts. 30-minute chart pulled off a trade station here, but you don't have to have any certain platform as long as you can execute your trades. We call it these trades for our FANG options trader subscribers. We're saying we want to buy the call option on Google right there at that 30-minute close, right there around that 1 o'clock Wall Street time bar. So you say, okay, 1 o'clock Eastern. And so stocks trading just over 94 here. What are we buying? This was March 15th. We're buying to the next Friday's, I think it was March 24th was the expiration. And you can see here, that's called the week 4 option. The week 4 weeklies in March. So basically the 4th Friday in March is when these things will expire. We will not ride them to the bitter end to expiration. We will be out before that expiration day. And for us with this portfolio, typically we're out and hold no longer than 3 full trading days. Okay, so but look, this is important. In addition to buying about a week and a half out, we're also buying well enough in the money that we're buying a 90 strike call. Stock looks like it's above 94. We'll just call it 94. $4 in the money, we paid $5.90 for it. You say, okay, so of that $590 you would invest, $400 of that's intrinsic value. That means that the other remaining amount, the $190, is what's called extrinsic or time value. So in this case, that works out to be about 70% intrinsic, about 30% time risk. You say, okay, well, you know, why do I want to hold that very long? Well, because the ADX is rising. As long as that green ADX line is going up, you are good. So the only problem is when it rolls over. When it rolls over here, that is an exit for us near 101. So stock's gone from 94 to 101. It's up about $7. Some 7.5%, and we're making about 71.8%. So almost a 10-to-1 leverage against the stock buying the in the money weekly call options. And you can see we bought it at $5.90, sold it at $10.14, right? So the idea of this is that you make 71%, you make $424 in gross profit per contract. Again, you shouldn't be paying. We would only buy one contract if you're putting in $1,000 here, because 590 you get one contract. 2 contracts pushes you over that $1,000 maximum. So one contract, you can see it's $590 risk to make 424. If it hadn't worked, if the ADX rolled over real quickly, then yes, we could have been stopped out for a loss. That can happen, and it will happen. But the idea is that you want to ride these as long as ADX is running to the upside. So that's a directional strategy using in the money options. It's a great starting point if you're new to options, kind of building a bridge from stock ownership to how to trade the option as with a stock owner's mindset, because you're buying a healthy amount of intrinsic value. Now, how do you start hedging positions when the markets are choppy? I really do love debit spreads where you buy one option and then you sell a cheaper option, typically at or out of the money against your in the money leg that you buy, to create still a net debit, a net cost to you, but it's a less of a cost than if you just bought the option alone. Because when you buy one, sell another, you're basically saying, okay, I'm going to reduce my net dollars outlaid. So like even that Google example, if I paid $5.90 for the buy leg, I could have probably sold the 100 calls for a couple bucks and taken it down from, say, $5.90 to $3.90 in my investment per contract by selling another leg against it. Now, what does that do? That's called a bullish debit spread, a call debit spread. If I do that, say buy the 90, sell the 100 when the stock was at 94, and you say, okay, that would be a bullish example. If it's bearish, then you're usually buying an in the money put, selling a lower strike price put that'll cost less but still give you some of the directional play on the downside. So the objective here is that, okay, you're going to have a sweet spot, which is highlighted by that, and then it's going to get capped. Like if we sold a 100 call, then we don't really get any upside over 100. And for that, giving up that upside, we're getting paid something. We're reducing our risk. So it's kind of a reduced risk, reduced reward compared to straight options buying. But it oftentimes allows people to have kind of a lot of comfort knowing that you're not having so many dollars at risk and that you're just trying to take out that steady kind of first leg up. They really do stabilize your portfolio compared to buying options. But you say, okay, what about finding big moves? Okay, this is probably getting now into the more aggressive approach. This is something that if you've heard of the option Greeks, you've probably heard of theta, which is the time erosion. But you may not have heard of gamma. Gamma is an important concept for aggressive options traders to know. Let's look at those Greeks real quick. One of the first ones that I always focused on for new options traders is buy high delta options. Those are the in the money options. That means that if the stock goes up $1 in your favor, if you buy an 80 delta, that means that your option should go up 80 cents on that dollar in the stock. So if you bought the option for, say, it's a $100 stock, you bought the 95 calls, $5 in the money. So you paid, $6 for them out about a week. And you say, okay, well then if it goes from 100 to 101, and if I got an 80 delta option, then what's my $6 option worth now on an 80% of that move in my option? It's worth $6.80, right? We got 80 cents on the dollar. You say, well, why would I do anything that's less than 100 cents on the dollar? Because you're paying a lot less than you would for that $100 a share stock, right? $100 a share of stock costs you 10 grand. You paid $600 to control $10,000 worth of stock. So when you get a 1% move in the stock up from 100 to 101, your option has moved up from 6 to 680 for more than a 10%. About a 13% rally there, right? So that's the leverage opportunity in options, and high delta options give you that kind of quicker bang for your buck. But, when you get a little more aggressive, you say, okay, theta is how much the time value is going to eat into our position. Vega is the volatility changes. This is more of an earnings related effect that you will pay up right in front of earnings. That's why I'm not recommending trading right in front of earnings. But then you will see that volatility, that Vega, get creamed after the earnings are reported, right? So you got to be careful with that. But gamma is not talked about very much, but it's how fast you pick up deltas, right? So when you're looking at an at the money option typically has a 50 delta, meaning it's about a 50-50 chance that it finishes in the money at expiration. Also meaning that on a 1-point move, that option moves up about 50 cents on that dollar. Those options are a little cheaper, so you still get really nice leverage on those. But as you go, say, from at the money to say the next point from, say you've got 100 call and the stock's at 100, you go to 101. Well, then that next point move from 101 to 102, now your delta may have risen from, say, 50 to 55. So now from 101 to 102, your option goes up 55% of that next point, the second point move. And so that's basically what gamma's picking up, is how much delta you're going to pick up on each next point move compared to the first point move that delta's measuring. So gamma in that case would be 5, right? You go from 50 to 55 from the first point to the second point move. So it tells you that you're picking up some extra deltas as that move starts to go from typically out of the money to in the money, is where you're going to get that kind of a maximum move. We've got a little chart that explains that. So how much you're going to see that benefits you. And of course, as you go further out in time, your gammas get less because you're paying up for those options. So you're going to get kind of less delta movement per point if you buy 3 or 6 months out. Gamma is always a positive number as an options buyer, because and the idea is that you're trying to pick up gamma if you're buying the options. Of course, if you're short gamma, then you're getting into, selling volatility, selling Vega, maybe being long time value on the net. But, that's not something that we're really that worried about. What we're worried about is, like, how do we get that gamma boost? So market makers are watching gamma real closely too, because they have to be careful, especially you get close to expiration, that you can see that, we're at the money and all of a sudden, boom, it goes in the money, that those deltas can go from very low to very high very quickly right near the expiration. But if you look at the historical results from our top gamma boosting trading strategy, we call it Grand Slam options. It's buying out of the money options for $1 or less per contract, $100 or less to control 100 shares of stock. You can see that going back to inception on that portfolio back to start of 2017, if you're putting $1,000 in per trade, a $10,000 account would have grown to $34,930. So again, you see that we've gone up by more than triple on a gross profit, adding up all gains and losses before commissions or subscription investments. So the idea is that, okay, $1,000 a trade, turn it into 24,900 and change gross. And of course, you got to take your commissions out. But again, the beauty is that commissions are so small compared to what they were when I started trading 33 years ago that, you know, it's really never been a better time to trade options, in my view, if you're considering options, than right now. A recent trade example from that strategy here. Here's one on AMD, Advanced Micro Devices. You know, AMD just got popped on the earnings yesterday, right? We weren't in for that. We said, don't mess with that. So when we look at this, we say, okay, we've got a couple of indicators signaling here. We've got the what's called the percent R. Larry Williams developed this percent range indicator, but we use it as more of a trend indicator, not a range indicator. And then you've got what's called the blue line is called the CCI, the Commodity Channel Index. We use it on individual stocks and markets on equities as well. And what you want to see is that both of those signal here. This is now an hourly chart signal, 60-minute. The first hour close at 10:30 on March 14th. Both of them surge and tell us that, okay, this thing looks like it's got some potential to move higher. And you can see stock was trading here near about $87. Notice what we had to buy to get an option under $1. We bought the April, we buy the monthly options with this strategy. So we go about a month out. So we were buying the April 21st options. These were about 5 weeks out till expiration. We paid for 105 strike call. And you say, whoa, 105 strike call, you're going like 20, almost 20 points out of the money, right? 18 points out of the money, more than 20% of the stock price. Sounds really aggressive. It is aggressive, but the idea is that we're looking for these things to give us fairly quick feedback. I paid 84 cents, $84 to control 100 shares of stock. 100 shares of stock would have cost us over 100 times that $84 would have cost us about $8,700, right? So you can see it's 101 leverage on the way in. And you see what happens at first here is that this thing stalls a little bit, and that worries some traders. But what I love seeing on this chart is that look at how the CCI, the blue line here, is staying above its overbought threshold. You learn all the settings, all the rules. We give you rule sheets with all these boot camps, so you get a flavor of exactly what the criteria are. But you see, the next time that we really get rolling on the percent R to the upside is in this phase, and that's where we get our first couple profits here. You can see on that next big trend move, we get the first target at 102%, right off of this first surge to about what 92, 93. So the stock's up about what $5 or maybe 6% on the stock. And then we get 102% on the options. Then it goes up a few more points up to about 96 here on this second move. That's where we're getting that 203% gain. And then on the third move here, interbar, you see right off that peak up to about 98 and change, we get our 304% profit. So 100, 200, and 300% profits, double, triple, and quadruple are our targets. And we take them out gradually. We take half off at a double. That gets you your risk capital back. That should free you up, not just financially, but psychologically, to say, I've got zero risk in this trade. It's the proverbial free trade once you sell half at a double. And then you're trying to give it a chance to make the next moves to 200 and 300% profit. All of these alert service examples are something where we call out real-time alerts via real-time email and text alert for our subscribers to each of those programs. Okay. Biggest obstacle for most traders, big drawdowns, right? If you're looking and saying, how far down that cliff do I have to go before I come back up, right? That's the fear factor. That's the thing you've got to be able to handle. As I said earlier on, whatever you think your maximum drawdown is, I suggest that you plan for not just that, but actually plan for twice the max drawdown, both financially and emotionally, that you can handle it. You know, think of the Jack Nicholson, you can't handle the truth from A Few Good Men movie, right? Can you handle the drawdown risk of any strategy you undertake in options trading and any trading strategy in general? You need to know that you can handle not just that drawdown, but even if it was twice as steep. that you could still stay in the game and not get blown out like a lot of other traders that don't think ahead about what their risk is. So that's why the money management techniques are so important. We teach a lot on that capital allocation, money management, trade management. When it does roll over on whatever our indicator is, we exit first and ask questions later. So we've got very clear criteria. We talked about just a few examples here, but the reality is that we've got a lot more strategies than just weekly options, debit spreads, and gamma trading. We've also got the credit spreads, using more of an income-driven strategy if you're looking for higher win rates and kind of slow but steady profit builds. The credit spreads are a great way to go, and a whole bunch more. I'm going to actually show you some of those that you might have been missing here. So like I said, we've showed you 3 of them, but actually we've got a total of 14 of them when you go to our BigTrends website, but I'll actually show you a special page that we set up for you here to actually take full advantage of those. And the key is that you don't want to be overwhelmed with, 14, I can't implement 14. Work on one thing at a time. Work on the one that kind of resonates with you. As like, yeah, I'd like to learn credit spreads. Okay, well then focus on the credit spreads. I'd like to make quicker profits, have our quick options boot camp. These are in and out in a couple of trading days, guaranteed, because we trade them pretty close to expiration on those. If you want to trade around earnings, we even have an earnings boot camp for you. We've even got a stock traders boot camp as part of this special, and a market timing boot camp, so you can learn the core market things that I like to see for defining the uptrend or the downtrend, breakouts, swing trades, and so many more. And of course, the big question tends to come up like, well, with 14 different strategies, how do you choose which one to learn? What I've set up for you today is a great way that you can actually get not one, but all access and all of these for lifetime. Okay, for your lifetime, to basically say you can soak these in with our BigTrends all access pass. And so really the power of this is that you see here that get not 1, not 3, but actually all 14 of these bootcamp sessions. They typically have 3, some of them have 4 different modules, so that it actually adds up to nearly 60 hours of content in total. Also, if we ever do another boot camp on something else, we tend to grandfather in all of our regiment buyers that have bought all of these boot camp sessions with that lifetime access, even to new content as well. From time to time, you'll see other things pop in there. I'm working on one right now. So the idea is that you're getting lifetime access. So you're not once you buy, you don't have to buy anything else to continue to have full high definition video quality recordings. And the most important thing is that in addition to that access to any future boot camps that's just bundled in there, you're going to get access to me and my analysts if you've got a question. So the beauty of that is when you take the typical list price for each boot camp's $295 times 14 of those boot camps and growing, it's over a $4,000 value. But what I've set up for you today is an insanely special offer, kind of my way of saying thanks to David and Anka for including me, and always love to help you benefit from this. Take that $4,000, I wiped it out and said, today's special offer, a one-time investment of just $275. People ask me all the time, why would you bring it this low? My experience is that when I educate my BigTrends folks and basically give you insane value like this, a lot of people are charging thousands of dollars for access to somebody's boot camp or somebody's brief training or whatever. It's like, I'm giving you insane value because you will not only become such a fan of BigTrends, you'll be a better educated investor and trader to make better decisions and keep you in the game for the longer haul. That's my objective, is to help you sustain yourself, not just with the trade that comes out tomorrow, but that you'll be around trading for your lifetime and not having followed the pattern so many others that try to hit it quick and end up blowing themselves up. We want to keep in the game for the long haul. So, and it allows you to apply more of your capital to your next trade, not to just the education that's being offered here. Thanks, David, for posting that. It's members.bigtrends.com/camp. And before I go and look at that page, I wanted to show you just some more detail on these boot camps. If you go to my BigTrends site under the training section, you see that these are all accesses that you get. So like 333 options, we actually scored a 30 bagger on AMC, the movie chain, when it was under all that kind of short selling, short covering pressure. And we teach you how to do that, how to find those really unusual moves. My top 3 indicator bootcamp, I alluded to the percent R. It also talks about CCI and ADX in that particular first of the 3 indicators. So I've shared with you each of those indicators today just with an overview, but this goes deeper, right? So this gets you into the top 3, the next 3 indicators, the last 3 indicators. Actually, there might even be 4 in that last 3 indicators. But bottom line is you get those kind of incremental primary, secondary, even tertiary indicators that you can use to give you more confidence in each trade that you make. Then we go into the overviews on the swing trading, more on the ADX with that one. The credit spreads is something where if you're looking for regular income, you can benefit from that. And the debit spreads I alluded to, but we do talk about the debit spreads there. ETFs, how to trade options on the big ETFs, not just the S&P and the NASDAQ, but actually the sector-based ETFs. So we'll trade industrials, we'll trade healthcare, we'll trade tech. And of course, with ETFs, exchange traded funds, you get to diversify so that no one stock's going to make or break you. The weekly options bootcamp I mentioned, definitely a popular one. Earnings bootcamp for those that like to take advantage of that and be careful about what kind of options you buy and make sure you can leverage that intelligently. Plus our market timing bootcamp and the Gamma options bootcamp kind of tying into that Grand Slam option strategy. And as I said, more are being built as we speak as well. So you get access to all of those. And when you go to the page that we set up for you as a special link, I'm going to answer some questions here in just a few minutes. If you got questions on this, do feel free to pop them in. But we really make our order pages incredibly simple. Members.bigtrends.com/camp. You know, I don't know about you, but my daughter's getting ready for a bunch of summer camps. So she doesn't go to just one. I'm a believer in keeping the interest up by having a lot of different things to choose from week to week. So got a tennis camp, got a golf camp, got a kind of a STEM learning camp, you know, mixing in different activities for both the brain and the body. You know, same idea here. We're mixing in different strategies, different trainings, different things that can help you to, back to the topic of today's overall presentation, talking about psychology and discipline, is showing you why you need these systems for whatever type of strategy you want to implement and give you meaningful specifics with the settings, the indicator parameters, whether it's ADX, whether it's percent R, whether it's CCI, whether it's a variety of other tools like the acceleration bands I created that helped me launch BigTrends.com more than 23 years ago. So you'll get a lot of insights on kind of what's gotten me here over my last 3 decades of my options trading experience. But you can see we've slashed that price down from the typical list price down to a one-time investment of just $275 for all 14 plus grandfathered in future access. It's kind of insane, really. But again, I view it as kind of a starting point for you with your BigTrends experience here. That once you see that, you may want to add on our alert service that goes with that strategy. You want to trade FANG options? You can inquire, and as a boot camp buyer, you'll get our best pricing on any of our individual alert services down the road, which we honor for our boot camp buyers. So it's something that's just been a very popular package here. So you can see here that what we have is that several ways you can get started. Any credit card you want to put in, get your core information here on the left, including your billing address for your credit card, right? So make sure those link up. Not if you've got like me, a different address for home versus work. Well, make sure you get the right billing one in for the credit card that you want to put in, or that orangish button down below here, PayPal. You can click that, and that will go into all that. We get a lot of questions about, so Terry said, do you take PayPal? Yes, we sure do. Thank you, Terry. Really simple, really easy and effective. Terms and conditions, right? So people ask me all the time about terms and conditions, and we've been in business 23 plus years. We stand by our products. We want to make sure you're not just satisfied, but ecstatic about, the value you got. But when you click on that terms and conditions link, it pops up like our terms and conditions and walks you through that. So if you've got questions about this is not an auto renewal. This is a one-time investment. Okay. So some people think like, oh, how many of those am I going to have to pay? You're going to pay one, $275 for lifetime access to this phenomenal value. Like I said, almost 60 hours worth of training for $275. If you break it down on a per hour cost, you're under $5 per hour of training. Okay. I don't know how to beat that anywhere for quality information. I know a lot of people say, oh, I can get free information on the web. Well, the reality is that battle tested? Is that served those freebie educators for the last 30 plus years? Is it going to serve you for your lifetime? This will give you lifetime access, and it'll give you lifetime support off of that training. So you see something in a session where you're like, I didn't quite understand that. You'll get a dedicated email to me and my analyst team, where one of my research department folks or myself will get back with you and say, here's the answer to your question as a boot camp all access buyer for lifetime. So, I don't know how to make it more attractive than that, but bottom line is that let me go back in and answer a couple questions as well. Daniel asked, back to the ADX, what was the blue and the red line? So if you came in late, and again, I can kind of pop it back up here by just having to sort of, give me 1 second. I'll bring that chart back up and share it here in one moment. You go back in and look at that chart on that ADX, right? So you came in late. So the idea of that is that the ADX is the trend indicator right here in green. The blue is a positive directional movement that says how much we're getting the net new highs rising. And guess what? If net new highs are dropping, what's the blue line do over here on the left? It goes down. If we're getting more new lows, what's the red line? It's barely going up because it's basically very choppy. And so when you see all that kind of consolidation on that left side before we got our signal, anybody who's trying to trade that prior day or two is getting whipsawed by any trend measure. That if you're trading, buy the dip, sell the rip, that works in a choppy trading range, but then you miss the big move when it goes up. You think it's going to go down, you bet against it, and you get burned, right? So the idea is that I don't want to trade that chop and mess up my mindset, mess up my focus. I want to wait. I want to stalk the trade. This one time where stalking is good, where you stalk the trade and you say, look, you're waiting, you're watching, and then you see, bam, the ADX crosses up. It also is above our longer term trend filter, which you'll learn what that is, that black line there. So bullish short term, that's what the positive DMI in blue above the negative DMI in red tells you, is that I overlaid those on the ADX. The original criticism of ADX was that it was basically trending, but it didn't tell you what direction. Now, by overlaying the directional movement lines, blue above red is positive. If red was above blue, it'd be negative trend. So we didn't put one of those on there, but you'll learn all those through the boot camp accesses here. Okay. So I'm glad you asked that question. The idea, my pleasure, Daniel, happy to re-review that for you. So, but the idea here is that, look, you say, okay, you're getting access to 14 of these boot camp sessions, each of them at least about 3 hours long, some of them a bit more. So the idea of that is that you say, this is going to give you a lot to absorb. So if there's one thing that people would complain about, it's like, man, why can't you just give me one thing and just have me just do that? Well, a lot of people would tell you one thing for probably more than that. But I'm saying, look, I want you to have access to all of them. So over time, as you get some time to soak one of them in and see how it works and get comfortable with it, master that first one, then you can go on to the next. And there's so much content here. We get people that tell me they've watched it 3 and 4 and 5 times, reinforcing the knowledge, and can't believe that we gave it away for such a low one-time price point. But the reality is, that's how I've built BigTrends over 23 plus years, is giving exceptional value, giving the support for fellow traders like you to start taking advantage of all kinds of market conditions, up, down, sideways, buying options, selling options, doing spreads, doing straight purchases when appropriate, so knowing when the timing is right. That's where that market timing piece will come in as well. So, can't reinforce it enough that when you go to members.bigtrends.com/camp, we kept it incredibly simple. I think I've got that link. We'll pull that up one last time for you. The last one on this slide deck here, just for one last reminder here, pop it right up one last time here for you. See, Special offer. You get $275, 14 boot camp sessions, nearly 60 hours of content, lifetime access also. This is not a limited access. You've got it for your lifetime. Full high definition video quality recordings, access to any future boot camps for free as well as added in for, that's why you only pay for that one-time investment at $275. You made a great investment in your financial future and in your knowledge base. So, a training program for selling puts, I would say no, but we do have the credit spread. If you're interested in selling puts, learn the credit spreads. It's basically a more limited way to sell premium, more limited risk way to sell premium than the exposure you get if you're naked a put. So we don't really do naked options there, but thanks for the question. But we do income strategies with this approach on the credit spread boot camp. So thanks so much. I'm going to hand it back over to David so you can get ready for our next presenter. There's a lot of great presenters to come today, so hang around for those. If you've got questions, of course, for us, you can always reach us on that order page I showed you. It's got our toll-free 800 BigTrends number or our client care at BigTrends.com as well. Thank you, David, so much for having me. It's always a pleasure and hope to see you again soon.